Hi, Dr. Banerjee. This is Sean Duncan. Obviously, this is case study number 3. We will be going over Royal Mail and the cost of capital. Once again, this project was done by me, Sean Duncan, and my partner, Sean Commuter. I will be handling the first 3 questions, and the other Sean, will be handling questions 4 and 5. So I'll be going over the background of Royal Mail and the background of Hillary Hunt. I'll be going over what is the cost of capital, obviously, and what is WACC, which is the weighted average cost of capital. Also, I will be going over The Heirs by Kyle Brooks of Ofcom, and I will be going over a couple of solution calculations that me and Sean calculated to get the numbers that we got on our case study. So I'd like to start off with a little background on Royal Mail. We can trace Royal Mail all the way back to the 1500s, which is crazy. I had no idea that Great Britain had a postal service all the way back to the 1500s. In the book of Brunner, it classified, it classified Royal Mail as a pioneer of the postal service, and the accolades clearly say so. First postmark, first people carrying on mail in a uniform, and the first countrywide letter delivery service. I mean, they are almost ground zero for postal service. They are the ones who started it all. Royal Mail was a government-held company until it was released by the government so it could take the monopoly off of the postal service in Britain, because they wanted other private companies to compete with Royal Mail. And during that time, during the time of when the government was trying to go to some private companies to give them a shot at the delivery service, the weekly stock fell of Royal Mail, obviously, during 2013, when the British government sold over 60% of their 1 billion shares of Royal Mail. So I think it was a great graph when it compared Royal Mail's weekly stock returns. I have it in my case study work, the Word document. I think it was Exhibit 1 or 2, where it shows the weekly stock returns of Royal Mail compared to a stock index. And we can see that little dip around 2013 all the way to about the ends and the start of 2014, when the government sold a lot of their shares. And ever since the government sold their shares, from the start of 14 to about mid-July, the weekly returns of Royal Mail have only gone up. So only a slight setback from British government selling all their shares, but it has rebounded successfully ever since. So now we're going to get to Hillary Hunt, who is a senior financial analyst for Royal Mail. She was the one discussing with other managers of Royal Mail of the cost of capital in the company, because Ofcom, who reviews the regulations for Royal Mail, a guy by the name of Kyle Brooks, said that Royal Mail's cost of capital wasn't good enough to basically for the company to be profitable. So that was the main reason we are doing this case, is so we can find out if Royal Mail is actually profitable. Because when I look at the weekly stock returns table, it looks like it's profitable to me. I mean, ever since 2013, when the government sold their shares, they have had a steady increase of cumulative returns, which is awesome. That's what you want as an investor. You want to see returns on your investment. So now we're going to get to my second question, and what is the cost of capital? I mean, it's in the headline of the case, so what is it? Cost of capital is the apparent risk taken by investors who provide the company some sort of capital. So it's So if a investor wanted to invest in Royal Mail, they need to take that person's capital and invest it into the company so that person can get their money back and probably expected return on it. So if Royal Mail makes an investment that doesn't exceed the cost of capital, the investor will look somewhere else. The investor is going to look somewhere else with a high return. Obviously, the investor is not going to look for a company with low returns because it won't be profitable unless they're showing good margins and good financial statements. So next we're going to go to WACC, and this is going to be called the weighted average cost of capital. I've learned it in the previous investments class and then in Principles of Finance. But the WACC, to go over again, is investors set WACC because the cost of capital is figured out by required return for investors by the debt and equity capital used. The average debt and equity that a company will use for funding is figured out from this WACC. So now we're going to get down to my final statement here, and my final question is, what were the errors by Kyle Brooks of Ofcom? He is one of the regulators or regulations for Ofcom, pretty much the SEC here in the United States. And one of the first errors that me and Sean found from Kyle Brooks was the calculation he made for cost of debt. He failed to take market conditions into factor for estimates, which is huge. You want to compare the company to the market conditions and the companies they're competing with. So Royal Mail had a credit rating of BBBs, which is perfect. I mean, it's telling the investor it is slightly risky, but it is also profitable. It will yield, which yields 3.776 for a 10-year maturity bond, going with a credit rating of BBBs, which is not bad. Doable, as they would say. So we'll get to the calculation for cost of debt, and our second error that me and Sean found was the use of dividend yield to estimate cost of equity. He should have used KPM to figure out this, and I'll get to the calculation of capital asset pricing model. It's a great evaluation tool for investors, and Brooks should have used, once again, the 10-year government bond, the beta given to us by the spreadsheets, and the market risk premium given by Exhibit 6 as well. So to calculate KPM, we're going to use 2.06 plus 0.65 times 5.8, and that will give us 5.8. Hold on, let me make sure this calculation is good. Yeah, it is. And compared to, we did a little graph comparing this 5.8 to the cost of equity of other businesses, and it's going to rank third out of 6 companies. I want to say the other 2 companies are bigger firms than Royal Mail, which would lead us to the higher cost of equity. Now we're going to go to WACC, and we're going to figure out a value for WACC of 5.416. 5.4, as we said in our Word document. And this is going to place us, once again, just below Tesco for third place, once again. And I said 2 bigger firms going to have inflated numbers. So when we look at these 2 numbers, they're almost on the lines of Kyle Brooks' number, maybe a little higher, which will lead to investors saying the higher number may be more profitable, maybe more money invested. Royal Mail's on a great outlook. They've been around since 1500. I doubt they are going anywhere anytime soon. As we read in the textbook, it still seems like, sorry, I was about to say Brunner, but Royal Mail still has some sort of monopoly on the postal service there in Great Britain. They're still bringing in sales. Sales growth is good. Stock returns is good, as provided by the graph shown in our Word document. I have no problems with Royal Mail. Thank you for listening, Dr. Banerjee, and hope to hear from you soon.